Hello and welcome to the fourth episode in the Oil and Gas Council's US webinar debate series. My name is Ben West and I am the Portfolio Manager of the Americas at the Oil and Gas Council. There are lots of familiar names participating and watching today. Andrew and Bill, it's good to see you again. We can't seem to get enough of you on these debates. But for those of you who are less familiar with us, the Oil and Gas Council is the world's most senior and influential finance and investment network for the global energy sector. Throughout the year, we host a series of private dinners, receptions, executive conferences, webinars, and podcasts. And on the back of all of these initiatives, we look to facilitate vetted introductions on behalf of our network in order to help place capital, buy and sell deals, and form new partnerships. In a COVID-19 world, we're continuing with these efforts, but of course, we're having to be a little more creative recently in finding ways to bring our community together. I think today we have a really topical and important discussion: what next for the US oil and gas industry under a Biden administration. I think in the context of our industry, the outcome of this election feels like one of significant historical importance and one that's going to demand change, and how the industry will fare will depend very much on its willingness to and ability to embrace this change as opposed to resist it. We have four excellent speakers today, and to take you through what this will entail and what the next steps are. But I think before I hand over to Andrew, our moderator Andrew, I just want to go through a couple of housekeeping rules. Firstly, when the debate begins, each speaker will have 5 minutes to present their reaction to the result of the election and to outline some of the major challenges or opportunities that the outcome will present the industry with. Once all is spoken, Andrew, the moderator, will lead an open discussion and draw on some of the more pressing issues that the speakers have raised in their opening comments. If you'd like to ask a question, you can do so by writing it in the Q&A tab, which you can access at the bottom of the screen. Our speakers will answer questions at the end, and I encourage you to ask as many as possible. Finally, should you have any technical issues during the debate, please use the chat function to speak with the Oil and Gas Council directly. I'd like to remind all speakers and participants that the debate will operate under Chatham House rules. That means if you would like to quote anything that any of our speakers say today, it is a legal requirement to seek the speaker's permission before attributing any comments to them. And finally, the speaker's views are not necessarily representative of their organizations. So before we begin, I'd just like to take a quick poll to see how you're feeling about the debate today. So let's launch that. I've allowed the panelists to vote as well. So how are you feeling about the future of oil and gas under a Biden administration? Are you feeling positive, negative, opportunistic, or are you still undecided? So we'll just give that another 20 seconds or so to get more votes in. Give that another 10 seconds. Excellent, let's end that and I'll share the results. 13% feeling positive, 36% negative, 23% see the opportunity or being opportunistic, and 29% undecided. So without further ado, I'll pass over to our moderator, Andrew Gillick from Enverus. Thank you also to Enverus for sponsoring today's webinar debate. And Andrew, back for more. I'll pass it over to you.
Thanks, Ben. Let's see if we can make some more folks more positive or opportunistic here by the end of the debate, or not. We'll see. Yeah, thanks again, Ben, for having me back. It's always fun to have these discussions. With me today, I have three great panelists: Bill Marco, Managing Director at Jefferies, Jordan Mari, Managing Partner at Denham Capital, and our very own Jen Snyder, Director on the natural gas side at Enverus. Really excited to sort of talk through some of the implications that we see for the post-election here, now that it seems like we have a path forward, although it's 2020, so you never know. Lots of different things could happen. And so we'll sort of talk through some, day one agenda stuff that we might see, and then sort of some of the other, political changes that may or may not happen through the next few years. So, like I said, we have Bill, Jordan, and Jen. We're gonna let them do some quick introductions, and then we'll get into it. So, Bill, why don't we start with you?
Thanks, Andrew. It's a pleasure to be on the panel today with everybody. Thanks to the Oil and Gas Council as well. I'm Bill Marco. I'm with Jefferies Energy Group in Houston. I've been there since Jefferies bought the boutique I was at in 2004. And I've been in the business 41 years. So this is my 9th downturn. The other day I kind of counted up downturns, and it's been quite an interesting business. Everyone is different. This one is different than all the others, of course. I picked opportunistic because I think it allows, hopefully, and I'll try and be an optimist here, but I can also take on the pessimistic role if I need to. But I think it allows an opportunity to have a conversation about balancing the energy business with climate change and with what the energy business does for the economy. And that it's still, with fossil fuel or oil and gas business, is still absolutely necessary. So I think if Trump would have got reelected, we probably would have put off the eventual, which is we've got to keep working toward having, really it's a test. You got to have affordable energy, reliable energy, and cleaner energy. And I think we continue to move toward the cleaner side of things. And I hope market forces are what controls the day, and not sort of forced legislation or choices that people shove down people's throats that don't make any economic sense or reliability sense. So I'd say at the moment I'm a little bit optimistic. I think you'll see things that Biden can do to, they talked about drilling on federal lands and maybe leasing on federal lands and pipelines. I think those will be negatively impacted, but maybe over time, not immediately. But I think ultimately what's coming out of this election is the kind of the left wing of the Democrats. That won't control the day, and the further left the Democrats move, the harder they're going to have in 2 years or 4 years. So hopefully they'll balance what they're trying to accomplish with the fact that we need an economy, we need jobs, and the oil and gas business is an important component of that. So let me close there and leave room for everyone else.
Thanks, Bill. Appreciate it. Jordan, I'm gonna quick
Sure,
intro.
thanks, Andrew. Thanks to the Lowell Council for having me. So I'm Jordan Marie. I'm a managing partner at Denham Capital. We're a private equity fund with offices in London, Houston, Perth, and Boston. We invest in oil and gas things, primarily upstream and midstream style investments. And then we have a power business where we build power plants all over the world. The vast majority of those are renewables. And then we have a small mining business that's focused on minerals that are essential to the energy transition. So we kind of cover the gamut in terms of the various policy debates out there. My general view is probably in line with Bill's to a degree, which is at some level, this election was, the best pragmatic outcome for the oil and gas business in the United States. And what I mean by that is, obviously we're going to have a divided government, or in all likelihood, we're going to have a divided government. We'll see what happens in Georgia. And the left wing of the Democratic Party that wanted to, push us hard to green spending at the expense of fossil fuels is probably abated for now. And in frank terms, also the right wing side of the Republican Party that would have likely reduced regulations even further and incentivize the oil and gas business to move quickly, possibly recklessly, that could have also had a really bad outcome on sort of the medium-term outlook for U.S. oil and gas. And so I think we're going to get a pragmatic center. I also think we have the one thing that people might be able to agree on is an infrastructure bill, and infrastructure is good for oil and gas, obviously, because of its energy intensity. So I'm optimistic. I think I'm realistic about what can be achieved, but at some level, governments are best when they govern least, and the there's a real chance that this new state of the world is going to be pretty pragmatic and pretty, reasonable or not intrusive in terms of new regulations one way or the other, with some caveats like the BLM and some other things. But in broad, big terms, I think we've got real venue to be optimistic here.
Great. Good to hear. Thanks, Jordan. Appreciate it. Jen.
Yeah, so same thoughts. I have to say I'm cautiously optimistic, essentially for three reasons. We have the potential for at least bringing to the table a pathway to more efficient pricing of GHG emissions. So at least it's part of the debate and potentially part of a compromise going forward. So I won't say carbon tax necessarily, but rather than a set of real piecemeal solutions, we have a potential to at least come to an efficient solution or talk about an efficient solution. The second thing is just kind of building on what Bill and Jordan mentioned. Just this could really be a positive for the social license to operate for oil and gas producers. So instead of stripping away the regulations and letting bad operators go as far as possible toward a questioning of that social license to operate, we may get a more a solution that's more in the interest of the industry as a whole longer term. And then finally, I want to kind of take a counter view on pipelines, just to point out that it hasn't been great over the last 4 years. So maybe actually moving toward an infrastructure push or more consideration of some of the benefits of potentially different projects could maybe clear the pathway, because again, it's been extremely difficult to get anything done over the past 4 years, despite some optimism at the beginning of the Trump administration. So again, those three things have me, again, cautiously optimistic.
I like it. Optimism from the panel. This is good.
That's why, hey, we're in the oil and gas business, Andrew. If we weren't optimists, we wouldn't be in it anymore.
That's right. Always chasing that next well, Bill. So with that, why don't we kind of start with the day one agenda that this administration will have when they sit down. Bill, what do you think the top 2 or 3 things that a Biden administration is going to try and push through here as soon as January 21st or whatever it is?
Well, I think related to the industry, I think infrastructure, I think that would be smart to do. If he could pivot from the Green New Deal, as initially presented toward, call it green infrastructure or call it or greenish infrastructure. I mean, a terrible name, but light green infrastructure. But something that would create some jobs. I think he's going to be, and I hope he's going to be sensitive to whatever he does, how it impacts the economy. Because I think if he loses the economy, if he starts to think about, big government programs, deficit spending, that's going to be a loser for them, and it's going to come back to haunt them quickly. So, I think, I think whether or not we rejoin Paris climate accords, it's significant, but it's not significant. I really think whether we're in them or not, the market forces are still going to move it in the direction that we go, to cleaner, lower carbon solutions, which is a good thing. Just because one's a member of the Paris Accords doesn't mean that one's making positive progress. And I wish that for us natural gas business, especially, we weren't always sort of on the back foot where we're responding to the environmentalists instead of saying, hey, we cut CO2 emissions a bunch in the US because of, going from coal to natural gas. And if they're going to attack us on methane, let's, it's easy to, not easy, a layup, but it's doable to have, very, very, very low methane emissions, which is where people can attack us on the gas business, gas for power, or LNG exports and that sort of thing.
Got it. Thanks, Bill. So Jordan, you mentioned something about, the balance or the moderate nature the administration may have. As you think about some of the environmental regulations that were rolled back in this past administration, do you expect that they come back in force right away? And if so, how does that impact the oil and gas industry?
Well, I can only react to what's sort of been said in the press and what the initial kind of posturing is by the Biden folks. And it seems like their day one motions are to join Paris, which, to Bill's point, I don't know that means a whole lot practically. Though I will say that LNG is a critical foreign policy tool for the United States. And so Joe Biden is a foreign policy person first and foremost. And so he's probably, that's probably a good thing for the LNG business and the gas business overall. But back to first day motions, I expect to see him move back towards the Clean Water Act, which Trump had a lot to do in terms of rolling that to erasing the Clean Water Act and those sorts of things. I think the real big question for the upstream producers in the near term is, what is this administration going to do about BLM lands? And they've got a variety of options there. They could ban, all drilling on BLM lands. They could ban new drilling, unpermitted future drilling, or they could say, this part of the world is off limits, and have at it in New Mexico, and create some kind of regional balance there. And I don't know the answer to that, but I don't expect there to be a day one BLM motion. If anything, if there's an infrastructure bill that's coming, and there's an infrastructure bill that needs compromise, one of the ways that Biden could get the left on board with that is throwing some kind of BLM action, likely on unpermitted future drilling locations, as red meat to the left in order to get them on side with an overall infrastructure bill. And so maybe that's in the mix at some point, but it doesn't feel like that's a day one sort of in the mix.
That's interesting. It's like he's going to save it in his back pocket to use in a negotiation, whereas there are other people who thought, hey, I'll get a quick, easy win with my left constituency and, ban new drilling on federal lands and, just go on from there, because it's in a lot of people, in people's minds who are not in the oil and gas business, oh, it's just a small part of the industry, or it's a small part of the economy. How many jobs are really going to be lost, right? Like, I think there's, a sense outside of the industry that, so who cares if they ban drilling? There's plenty of oil, right? Like, shale's everywhere, and well, whatever. Okay, so. Well,
and to Bill's point, like, this president should care most about jobs, right? In all likelihood, the COVID thing will get, it's easy to say this today after yesterday's Pfizer news, but in all likelihood, they're going to get a hold of COVID at some point over the next 18 months, at which point the president's job over the remainder of his first term is to get the economy back on track. And the biggest lever he has to pull in that respect is an infrastructure bill. And that's going to require, 60 votes at some level. And so he's going to need some things to give to the left in order to get them on side. The same way President Obama did, with the moderate side of the Democratic Party to pass Obamacare. Like, you're going to need to break out a lot of legislative trades in order to get a big bill like that through. Maybe I'm wrong about that, but that's my instinct.
Yeah, and I was going to say, let's not forget that part of the oil export ban, part of the compromise there was extension of ITC, PTC. So there is some precedent for that. And I wanted to go to day one. One of the Trump administration moves in their first 100 days was to turn over the Obama year's methane limits on new oil and gas operations. And that will very much be one of the first initiatives of the Biden operation. And I'd go toward social license to operate there. We think that could be a positive in that it does support more responsible operations for oil and gas producers. So I'd look for that again, limits on methane emissions from new oil and gas operations. And it's manageable. The costs are manageable. It's kind of been a bit of a black eye on the industry.
Yeah, Jen, I think we lead with our chin when we allow these bad operators to, like a few people are causing most of the methane emissions. And I think it's smart when the majors got together and national oil companies got together and said, we're gonna voluntarily monitor methane emissions. It's really easy to do, and it's the best way to attack the natural gas business. So it's the easiest thing to defend against being attacked in the natural gas business, I think.
That's right. I've said it before. Can we just please stop flaring gas? Right? Can we get together and do that?
It seems like the Railroad Commission, I saw some headlines out yesterday that they were going to mandate a much smaller percentage of whatever is being flared going forward, which would be a pretty big step, especially for Texas, right?
Yeah, I mean, we're flaring a lot less than we used to be in Texas since the downturn, but absolutely limiting the duration on those flaring permits would be a positive. It's been a black eye.
Well, and we're going to need that nat gas come this winter, right, Jen?
There you go. There you go.
So, all right. So, day one, we may or may not have some BLM action. Seems like it could be a pretty good card for the administration to use down the road. Certainly, it seems like we'll see some of these, environmental and emissions regulations that were rolled back, maybe, pushed back forward. Maybe some of the CAFE standards. I know we didn't talk about that, but that's certainly something that the auto industry was moving towards, and I can't imagine they slowed down too hard on it. But I wasn't following that as closely. And then potentially rejoining the Paris Accord. Something I learned recently about the Paris Accord, I didn't really fully understand or appreciate the impact that it was having. My thought was it was just countries and governments agreeing to meet certain greenhouse gas emission goals at a future date. But I guess it's really hard for governments to mandate that. But what it actually does is it pushes where government pension fund money can flow, and it's the influence of those dollars that is, I think, helping to push the ESG or agenda forward. Jordan, you mentioned while we were all talking before it started that you're seeing this in some of the investments that you guys are working on. Maybe you want to elaborate for the.
Sure. So Denham, we have a long history of power development in emerging markets, and frankly, we built power plants, natural gas, and mostly renewables in places that need power. So the state of Texas doesn't need power. It's always incentivizing a more efficient electron in the market, but places like Ghana, the lights 10 years ago didn't come on 42 days a year. So we build power plants in places that need it. And the fastest, not always the cheapest, but increasingly the cheapest, but the fastest electron you can bring to a market that needs power is typically a solar panel, or in some places a wind farm. And so one of the things that we've seen a lot, given all this talk around ESG and renewables and energy transition, is that the real capital leaders in that space have been DFIs, and that is the institutions, the governmental institutions in European countries, in United States and Canada, who are voting with their dollars, to Andrew's point, to really spur these renewable investments. And so we see the endowments and the public pensions, they're active participants in our funds, but the people, when we have a new idea, when we have a new fund, when we have something that's a little further afield outside of a given fund's mandate, typically the first dollars to show up in our power business are DFI dollars, which are a direct corollary to Paris Accord and governments setting this energy transition as a priority.
Hey, Andrew, can I add to that?
Yeah, please.
I think, BlackRock and others started really focusing on more ESG friendly investments and being aware of ESG impacts as related to, you know, investments in the energy industry. And I think that's an unstoppable trend that's going to continue. You know, the kind of that combined with the really bad returns that the upstream business has yielded over the last decade, I think there's real stress on the upstream business that, look, we got to figure out how to do business better. I think we were mostly it was mostly a reflection on we found so dang much oil and gas that we, you know, killed the price. And so we were lousy investments, but we were extremely successful in finding volumes, which ultimately is good for the U.S. I mean, we have some of the lowest costs of supply in the world, and good. So that's good for the economy. But I think the real power now seems to be on the investment community, and whether that's endowments or that's, you know, major, you know, sovereign wealth funds, you know, all other foreign investors. Yeah, I think they're going to lead with more. They're sort of forcing the business to address, not all the business, but some of the business to address ESG. You know, you guys have to be more conscious of this.
Meaning that these LPs, the pension funds and endowments that you mentioned, don't actually need I think was Jordan's point before, you don't actually need the Paris Accords. They're already doing it on their own. This ESG movement is, the train's already left the station, and, you know, get out of the way, because this is how, you know, investors, the investor mindset has changed, it's evolved, and, you know, moving towards maybe a more balanced, you know, somebody said an energy business balance with climate change. So no, that'll be.
That's right. And look, this panel is to talk about the administration's impact on the oil and gas business. The biggest issue in the oil and gas business right now is returns, to Bill's point. And so, you know, I think Bill can correct me, but I think energy is the lowest component of the S&P. I think it's less than 2% right now. Maybe it's a little higher than that after yesterday. You know, the challenge in this business overall is to create returns while also moving towards the clean goals that society at large, not just, you know, some random government somewhere or random politicians, but these politicians have a mandate from their stakeholders. So creating returns while moving towards a cleaner transition. And that's a complicated, hard problem to solve, but that's the next 10 plus years of this industry.
Yeah, I think that's right, and I know energy transition is the common phrase that's used, and I like to use the phrase energy evolution, right? Because energy transition suggests like we're moving away from fossil fuels, and I know everyone on this panel will agree with me that we're not, and probably most people dialed in listening. Like, we need fossil fuels, whether it is for, you know, that move from fossil fuels to renewables, but that's a long time. I mean, Jen, as you think about the role of natural gas now and the way that you expect this administration to treat it, like, you know, is it like the transition fuel, or is it the fuel of the future here for the next couple of decades?
This isn't anything new, but I think what it is the schizophrenic fuel, right? And one of the things that we hope is that you kind of lean into the fact that gas is a real good partner for renewables. It's a low-cost solution now and has been in terms of reducing emissions. And so we'd hope that the pragmatic side of this, you know, pairing of you know, possibly a red Senate and a Biden administration, like brings that pragmatism to the floor, because, you know, gas offers a ton over the next few years in terms of meeting those goals. And I mean, we've talked about it, that the train has left the station, right? And, you know, getting more efficient solutions rather than what we're seeing now in terms of pricing GHG would be, you know, good for the gas industry and, you know, good for meeting those goals long term. So instead of a, you know, solar goal in New Jersey, you know, let's think about ways to price carbon so we can come up with a holistic solution. And gas is part of that.
Sorry if I can add to that. I think that gas is also very viable for national security interests. You know, LNG exports over to Europe to push back on Russian gas and how they might use that. If you want to get Asia off coal, natural gas is the way to get Asia off coal, and a low cost solution. And then natural gas fits really well for, wind and solar. When the wind's not blowing and the sun's not shining, you can flip a switch and supplement it with natural gas power gen.
Yeah, I mean, I think the rolling blackouts again in California reminded us that we need to do a little bit better job of planning. The American power consumer expects power to be there every day. In other countries, that's not necessarily the case, as Jordan mentioned, right? Like 42 days a year, that's not good that you can't turn the lights on. But the American consumer expects there always to be power when they want to plug something in or charge their iPhone or whatever it is. And so, until this battery storage technology kind of evolves to the place where you can store that renewable power, I think natural gas seems to be the most prudent, lowest emission fuel for us to use going forward. So, Jen, on that note, like you were cautiously optimistic about the potential for pipelines to be approved. I mean, we're so far from a new pipeline. I mean, we're about to shut DAPL down again, right? Like, how does another nat gas pipeline get built?
Yeah, so I mean, even in the last 4 years, the industry has had to think about living within established right-of-ways, right? But what I want to focus on is kind of the untold story of the cancellation of ACP, and just yesterday, MVP stay was approved. So again, more delays on that pipeline, but those pipelines would have allowed the substitution away from coal in the Carolinas and Virginia with natural gas. So a positive in terms of emissions. So, we have to be sensitive about where you're trying to site these projects, but smaller projects, like getting the GHG benefits of substitution toward gas and away from coal on the table could possibly be positive. But again, we haven't been able to site new projects effectively over the last 4 years. So let's look at that cost benefit and get the GHG piece on the table.
Well, and when you're pulling the gas from Appalachia, from states that are focused on capturing all of those molecules rather than flaring, right? Like, isn't that another reason why you would want to have a pipeline to be able to move gas from those regions and just support, like, rather than West Texas and
negative Waha prices weren't good for anyone, right?
That's true. So you guys mentioned an infrastructure bill versus a green infrastructure bill. How do we tie that together? And what do we need to see from this infrastructure bill that'll both support the industry but also allow the Democrats to have a win with their left parties? Bill, do you have an idea on that?
Well, I think one thing you got to do is I'd think about it on the other side too, is you got to do something that the Senate will approve. So, you've got to have something in it for what would probably be a Republican Senate. It's going to be a complicated discussion. I think this will be the test where the moderate Democrats and the left-wing Democrats, kind of have a kind of a battle to see what they can get through. But if it includes a lot of the stuff the left-wing wants, I think it'll never work.
Yeah, Jordan, what do you think?
I think Bill's right. I think it's going to take 60 votes in the Senate, and that means it's going to be a big grab bag of compromises, which will mean, red meat for both sides of the extreme, sides of both caucuses, and then, whoever gets the 61st is going to be the winner in those compromise races. Look, I don't think a federal mandate on midstream infrastructure is going to spur on midstream infrastructure is going to spur new, midstream development. I think it feels to me, in my experience, that really sort of the states and local jurisdictions are what govern sort of midstream development. So I don't think we're going to get an infrastructure bill that says more pipelines and everybody's going to high five because there's going to be more pipelines. Could be wrong about that, but that's my instinct.
We can't high five right now anyway because of
right,
COVID.
exactly, and it's not a federal thing, right? That's causing that headwind. So I don't know that we can rely on the federal government to do any better, or if that they would even attempt to do any better. So then, the infrastructure bill then looks like roads and bridges and cell phone towers and solar panels and wind farms. And all of those things are tangential benefit to the oil and gas business from a consumptive standpoint and from a economic demand standpoint. But they're tangential benefits. They're not direct benefits.
Right. So well, you said wind and solar in there as part of the infrastructure build out, and charging stations are probably in there too, and whatnot. And whether the federal government does that or the utilities, we can leave that debate to somebody else. But from your point of view, and maybe like hanging along on what Jen was suggesting, is it possible that we would see a federal mandate on renewables targets across state, or is it going to stay as a state by state situation?
Well, the only way the federal government can impose that is through incentives. And, the cost of capital for renewables right now is impossibly low. It's like low single digits. Right. So like we have a massive capital incentive right now, or a massive amount of capital chasing these assets in the normal course. And so, we have lots of incentives to build new solar, new wind. And so the federal government can put their hand on top of that and stack incentives onto the pile. But when you can sell a solar development for a 4% cost of capital or a 6% cost of capital, that's a pretty high incentive for developers to build those things. So I don't know if the states will. It seems to me that there's just going to be more of everything.
Yeah, great. That's what we need. more of everything. Less coal.
Well, assuming that we have the economic output it's a circular reference, right? Because we have to have the economic output to support those assets. But hopefully we can post-COVID. Yeah. There'll be a demand function for all the supply of that capital and the supply of that of those assets.
Yeah. One thing I hope as part of infrastructure is, I call it Wi-Fi for everybody, where instead of, in the 50s, it was interstates, and now it needs to be kind of electronic interstates. So, you look at, we have unequal access to that for people, and you have people needing to work from home and school from home. And, hopefully that's a pretty important part of how we think about, really modernizing. I don't know that we need more roads, but we surely need the roads and bridges fixed, as well.
Yeah, no, that's for sure. Certainly around here in the Northeast. Jen, was there anything else you wanted to add around kind of a federal renewable mandate?
Yeah, I just stress that natural partnership between renewables and more renewables and gas as a backup for the intermittency that we know and we see day-to-day in jurisdictions with high percentages of wind and solar generation.
Got it. All right, so we got a bunch of questions coming in here from the audience, which is exciting. A few people asked what DFI dollars mean, direct foreign investment, right, Jordan? I think.
Yeah. So OPIC in the United States is an investment institution that the federal government gives money to go make investments all over the world to further U.S. interest. And so they invest in, hydro plants in Africa and, bridges in Asia and things it's essentially the economic arm of U.S. foreign policy. Most all development governments have these DFIs that are active in the marketplace in the normal course. And they're return seeking and economically rational actors and those sorts of things. But it's just a tool in a foreign policy toolkit to further a given country's interest.
Got it. Perfect. Thank you. Jen, this one might be for you. With Biden being elected, he stated that he will not let the Keystone Pipeline go forward on the U.S. side of the Canada-U.S. border. With U.S. oil production declining, current future demand on heavy oil, and increasing imports of light oil, what are your thoughts on Biden reversing his decision on allowing the permit to permit this pipeline? ESG standards in the Alberta regulatory framework is already top tier. I'm guessing this question is from a Canadian. I would like to think that would help influence any decision.
That was a question with an answer within the question.
I think the question is he going to change his mind?
Look, we'll see, but right now there is no lack, even with the decline in U.S. production. There's no lack of oil within the U.S. So say a wait and see on that one.
Yeah. Anybody else thoughts? I kind of agree with Jen. It seems like there's no rush to reverse that kind of decision.
I think it'd be really hard for him to reverse it because it's a 12-year path that they were on from the previous, the Obama-Biden administration.
Yeah, that makes sense. So here's another one. Can you talk about some of the state level regulatory issues and the threat for those to permeate through the country? So Colorado setbacks, New York bans on fracking, etc. Bill, do you see anything beyond those two that were just mentioned that at other states that might be at risk for this kind of regulatory environment?
I think environmentalists will keep attempting to do that. If you can't win at the federal level, try and chip away at things on the state level. I don't know if I see, if I see any other, I'm thinking through the states here, if I see any sort of emerging issues, those are probably the two better examples. I mean, the ability to prosecute drilling in New Mexico is really a federal issue, but it's an issue related to New Mexico and how much federal land there are. So it's not, strictly a state issue. But I think, people will try and find examples of things in this or that state and see if they can, propagate it in other areas. I can't name any other ones. I don't know if the rest of the panelists have any good examples, Jordan or Jan.
I don't. I think across the board, you're going to see a mandate from even places like Oklahoma, Texas, and Louisiana for the oil and gas industry to do things cleaner, safer, better, with less intrusion. I think there's just a social mandate in that respect. But I don't North Dakota is not going to change the rules wholesale the way Colorado has.
Or West Texas, right? It's not like they're drilling under people's suburban homes, right? The same way.
Unless you live in Vegas. But yes, that's true. Or Midland, for that matter.
That's true.
I think conversely, I saw something interesting about a month ago in the New York, I think it's the Times, showed where does your energy come from in all 50 states. And it's a really neat graphic that shows how energy supply has changed state by state, whether it's gas or nuclear, coal, hydro, whatever. If the states are smart, they'll continue to promote, what makes the most sense, what's the affordable, reliable, and cleaner.
Yeah,
and there's no one size fits all state by state, that's for sure.
Right, it just depends where you are and what's closest and available for consume. Sure. All right. Well, so here's another one. Does return to a globalist agenda? I guess this is election related, equate to a stronger growth in Asia, Africa, and other emerging regions. Following that assumed growth, a higher demand for coal, oil, and natural gas, or do we skip that and move more towards renewable power? Jordan, what's your thought there?
I mean, equalize for a post-COVID world, right? I think the U.S. should use natural gas as a lever of its foreign policy, and China, no doubt, will use coal and its sort of infrastructure spending as a lever for its foreign policy, and all that means more fossil fuel demand. But I also think, again, as we're in a lot of these emerging markets, the cheapest, fastest new electron you can bring to a market is a renewable electron. And so I just think you're going to get a steady march of more of all the above. And I think that's probably supported by monetary policy of, kind of infinite money printing. And so you're just going to get a lot, again, equalize for a post-COVID world, right? I think you're going to get a steady march of more of everything.
Yeah.
Sounds good. Jen?
Just to build on that, I do feel like there's an inexorable move away from coal, though.
Oh, fair.
And the reason is just that gas prices and LNG prices in particular have come down so much that it's a really cost-effective way of meeting emissions goals and air quality goals. And we've found so many buyers with low global gas prices over the last year for LNG that gas is stuck in the middle. So more renewables, less coal, and you pick your path for natural gas, but it's up to us to make an effective environmental argument for gas as a transition toward a more renewable heavy future and a very cost effective transition fuel at this point.
That's a very fair point. I think in terms of met coal, because we have a meaningful position in met coal, and met coal has a huge demand framework for infrastructure spending, but your thermal coal is the main event, and I think you're exactly right in that respect.
Cool, thanks guys. So Bill, this one's for you. Under the new administration, do you think this will further accelerate consolidation among the E&P operators? I know you want the answer to be yes, as an advisor. Will the big service companies continue to step away from the North American market? So I guess that's two questions. First on upstream and then on service.
So yeah, this business is going to shrink 25%, and this whatever administration it was in, and 25% is a nominal number. It's more figurative than literal, but everything's got to shrink. The number of companies, the number of employees, the capital spending, it was over invested in, and it'll shrink because it's going to be starved to capital on the one hand, and it'll also shrink because there's just not going to be necessarily the opportunities on the other hand. So I think that's sort of regardless of it might change at a different pace in the different administrations, but it's going to get smaller. And I think in terms of the service companies, follow the rig count. They're going to be as interested in U.S. as the rig count goes. And, think about the last 5 years. We went from 2,200 rigs in 14 to, 1,100 in 16, 17 to 800 last year. And, now, I don't know, it's 350 or 400 at the moment.
6 rigs running last month, I think, Bill. Maybe 7. I don't know. No, I'm kidding.
So I think that's got to get scaled down, and perhaps to a greater extent, because a rig does more than a rig used to do. So if you have crews per rig, you're going to have a lot less crews, and you're going to be accomplishing a lot more per wellbore. So I think it's going to shrink dramatically.
Certainly seems to be the trend. We haven't talked too much about crude and crude demand. A couple of questions have come through on that. I think mostly because the world is focused on natural gas right now, but certainly, we're not going anywhere without the crude supply here in North America and around the world. Do you guys want to, or you folks want to comment on whether or not, the European majors who are calling for peak demand now versus the U.S. majors who see peak demand later, who may be right, or sort of outlook, for the next 5 to 10 years. Jordan, you want to start? Mute. Yeah.
Sorry. We're participating in a thing this morning, an auction process.
He's doing a consolidation deal right now.
No, he's responding to a text. I apologize. That's poor form. Ask me that question again, Andrew.
No, we're just talking about like how we see crude demand. Have we reached peak demand, just like the European majors are talking about, or is it 10, 15, 20, 30 years away?
I don't know. I know that even under BP's sort of rapid transition model, where we're kind of at 100 million barrels for the next 10 years, some version of 100 million barrels for the next 10 years, you need something like $60 to $100 billion a year of capex in North America, or in U.S. shale, actually. And so, if it's better than that, I think that's very supportive for this industry. And it's hard to believe it's going to be much less than that. So, the real question for my mind is in the short term, and that is, what is the demand response? What does the curve of demand look like vis-a-vis COVID? Both in terms of how much longer this lasts, and then what's the recovery framework? I think financial markets would tell you that as soon as someone says COVID might be gone, everything goes up and to the right. I don't know that that's true on oil demand, but that to me is like the big X factor. We're not particularly worried about the next 10 years because I think we live in a 100 million barrel world or better for the next 10 years.
I think that makes sense. I mean, I think yesterday's reaction was, silly. COVID is potentially, fading away in the next 6 to 12 months. So like the middle of next year, rather like than the middle of next week. So for the front month to have rallied the way that it did seemed, obviously optimistic and people are excited, but probably not, prudent for the near term.
We've got to turn a vaccine into a vaccination. So just because we have a vaccine, now you got to distribute it in 2 doses at minus 94 degrees to 300 million people just in the U.S. And then you can't just fight it in the U.S. because there's no non-peeing area in the pool. If someone pees in the pool, then
Yeah. So a lot of wood to chop, but I think that's right. I think it's the near-term demand recovery versus the longer-term outlook for crude. Jen, is there anything you wanted to add on that, or no? Cool. Someone made a comment regarding Russian gas in Europe. I think just to clarify that, we're talking about using LNG, shipping it to Europe as a political tool to wield more political influence in Europe versus the Russian influence from their gas or being pushed from the east. I think that was just kind of the reference there. All right, I think we got time for one more here. Let's find a good one. There've been I'm seeing a couple of questions about minerals. What do you think the impact will be on the mineral A&D space, or will anything that change? I mean, I think that probably goes along with state regulations versus any federal regulations. I don't know, Bill, do you see anything changing on the mineral space?
I think on the mineral space, it matters kind of return expectations. So mineral space will be correlated to how optimistic am I in rise in gas price or oil price. I think, it's kind of the play. It's a way to play the commodities without all the risk of upstream. That's how I think about it.
Yeah, I mean, same, right? Like you own the minerals, you get the value out of them if they're getting developed. Otherwise, I mean, no, I don't think the government taking them away is effectively I don't know, un-American, take your land.
Well, and most of the minerals are ultimately owned by private landowners.
Right.
You know, rather than the government.
Right. It's a pace of development thing. So,
Yeah.
you know, if you kind of believe the current sentiment, oil minerals are probably slower to get developed in today's world, and gas minerals are probably faster to get developed. And the asset prices for those various, mineral assets fall out accordingly. And so it's probably a good time to own a bunch of gas minerals, and maybe a less good time to own oil minerals. But, you know, there's also an underinvestment thesis in the North American oil shale world, whereby, you know, if you believe in a post-COVID demand framework, and you believe that the U.S. is some version of the swing barrel in the world, like we're significantly underinvesting in the supply infrastructure for oil barrels in this country. And so you could have a you know, in the next 2 or 3 years, a big oil price spike, and therefore development of those minerals goes up. I think OPEC's a little bit of a lid on that thesis, but in any event.
I agree. I mean, I think OPEC and the idea of U.S. returning to a deal with Iran, you know, bringing the Iranian barrels back on is that lid that you're talking about. But, you know, a couple of years pass, we get past 100 million, 101, and then, you know, you're going to need those U.S. barrels again, like you said, in the swing barrel thing. All right, it's looking like we're getting towards our time here. We have a few 30 seconds for each to give a couple of closing remarks. Jen, you want to start? Mute.
Yeah, I mean, watch this space. Again, we're cautiously optimistic about, you know, potentially moving in the right direction in terms of the social license to operate. And, you know, we do want to stress the natural pairing and the cost effectiveness here for the next 5 years, the next 10 years of natural gas.
Thanks, Jordan.
We're committed to this space, both on the upstream and the power side, and think there are going to be, you know, pockets of opportunity across the board. On the oil and gas side, you know, the political winds will come and go. What is absolutely critical for the oil and gas business is to produce returns and do it safely and within the mandate, the social mandate that Jen just talked about. But we got to produce returns. And so, you know, what we're focused on, and what I think all industry actors should be focused on, is producing, you know, meaningful returns for their stakeholders. And I think that's the surest pathway back to industry health, regardless of the political winds.
Yeah,
and I think the political winds will be okay. Like, I think it's going to be a pretty good time to invest. You won't have a lot of exogenous political risk in the system. And so we just got to focus on giving people back more money than they started with.
Sounds like a good plan. Bill?
Yeah, I'd like to see us, you know, not swinging pitches in the dirt from the environmentalists and kind of stay out of the noise. I absolutely agree with Jordan on returns, and with Jen on natural gas. I think that's, you know, until we can show returns, we don't have a lot of license to scream about, you know, a downtrodden business. We got to do returns. I hope we can continue to do a better job of demonstrating how important natural gas is in so many ways, and kind of get on our front foot with, you know, telling that story.
Yeah, thanks, Bill. Look, I think it is a very exciting time to be an investor in the energy industry, whether it's traditional energy economy, new energy economy. There's a ton of opportunity out there. As you know, we kind of get a reset here, you know, with, you know, the oil and gas production because of COVID, and, you know, the new opportunity in the new energy economy as, you know, the ESG movement builds strength and momentum here in North America. So thanks, everybody. Really appreciate your time. It's been a great discussion. Ben, any last things here? Do we want to do like the panel,
No, thanks, Andrew, Bill, Jordan, and Jen. It's great. Before we go, I just want to see if your cautious optimism's rubbed off on the audience. So let's relaunch the poll quickly. So there we go. Let's see how that. We'll give it 20 seconds or so before we wrap things up. So we'll just give that another 5 to 10 seconds or so before I end it, and I'll see if I can share that again. So in 3, 2, 1. Let's end that. I'll see if I can share it. It's 20% are feeling positive, so that is an increase. Well done, guys. 15 still feeling negative, 43 feeling opportunistic. So I'm glad everyone's left feeling on a slightly more positive note, and just 23% left undecided. But no, thanks again, guys. Really appreciate it. Thanks to Enverus for sponsoring the debate today, and finally, just thank you to the speakers, to all of our speakers, for sharing the time to share your thoughts, your insights with us, and sort of where you envisage the next steps and the most important steps forward for the industry. I think if any of you watching would like to speak with any of the speakers about any of the issues that have been debated today, then please email me directly at benjamin.west@energycouncil.com, and I'll be happy to put you in contact. But other than that, I think it's just all that is left for me to say is we'll be taking a short break from our US webinar debate series, but we will be launching the next round of episodes for our Investor Series podcast. We've got episodes coming in the next couple of days from Mark Viviano from Kimmeridge Energy, from Glenn Jacobson from Trilantic Capital Partners, Avik Day from CPPIB, and Pickering from Pickering Energy Partners, and Griffin Perry from Grey Rock Energy Partners. So that's on the way. Keep an eye out for that. I think there'll be interesting discussions in the times ahead. So please do keep an eye out, give it a listen, subscribe, and no, other than that, thanks again to the speakers, Andrew, Jordan, Bill, Jen. Really appreciate it. Really enjoyed it, and we'll look forward to seeing you next time.
All right. Thanks, Ben.
Everybody.
Take care.